backed and powered by 150 years of business experience. Venue is a virtual data room trusted by the best of the Fortune 500 to move deals seamlessly from one to the other to the next too.
The wheels are spinning on transport M&A, specifically in trucking, where a flurry of deals this summer, highlighted by UPS's $1.8 billion takeover of Coyote Logistics and FedEx's $4.8 billion deal for TNT Express, have kept bankers busy. Logistics firms are also in the crosshairs of both private equity buyers and roll-ups, with XPO Logistics alone committing more than $6 billion this summer to acquire Conway Inc. and Norbert Dentressangle. Deals like these are one indicator of the steady climb by transport firms from the lows of the recession, but analysts are warning that we may have already seen the peak for the trucking industry, with demand plateauing and costs moving higher. Today we'll discuss these and other factors driving M&A and finances in the sector. My name is Mark Aiello, Vice President General Manager for Venue, the virtual data and platform of R.R. Donnelley. Today I'm joined by Charles Otton, Managing Director at UBS. Charles, thanks for joining.
Thanks for having me, Mark.
So as we look at the space, what are you seeing in terms of valuations and where do you think they're headed?
Well, that's a great question. And we've seen, I think, a lot of different valuations appear in different subsectors of the transportation market. So you highlighted in your opening remarks a lot of the logistics and the trucking multiples, but where we sit, transportation is pretty broad. So we have airlines, we have transportation logistics, we have the integrators, we have shipping, we have travel and aircraft leasing companies, all under the umbrella of transportation. And each one of those is in a slightly different part of their evolution. Airlines are a fully consolidated industry now. Valuations tend to be in the 5 to 6 times EV to EBITDA with an R. With the companies that you refer to, in trucking and logistics, we see truckers at about 6-7 times EBITDA, EV to EBITDA, and we see the logistics companies on average trading at about 10 times EV to EBITDA. And then you have the railroads, which are in most cases around 12 times EBITDA, so quite a mature industry. Where are they headed? I think airlines, as a fairly consolidated industry, have only a little bit further to go, is our view. The logistics sector has seen a lot of activity, and there is some suspicion there will be more activity there. And you could argue, as the most mature part of the food chain, railroads, they're at a fairly standardized level at the moment of about 12 times EBITDA. The absolute end game, the poster child, is the infrastructure sector, in my view, where we've seen toll roads change hands for 30 times EBITDA.
And across these very different subsectors, where are you seeing the most significant opportunities?
Well, as I say, I think for airlines, it's a fairly consolidated market, so unlikely that we'll see too much activity there in the short term. Where we are seeing activity is in exactly the space that you highlighted, in logistics, in trucking, mostly in logistics businesses owned by private equity, and that's been a feature of this market. In fact, you yourself referred to a couple of the deals that were currently or were owned by private equity that were sold to strategic or corporate buyers.
And how are you seeing deals being structured across these different spaces?
Very interesting. So 2-3 years ago, we were seeing a lot, maybe 5 years ago, we were seeing a lot of deals done for equity swaps, mainly because companies couldn't afford the cash required to pay for these transactions. And so the airline deals that were done 5-6 years ago were all stock deals. Now we're seeing, on the back of cheap credit and an available financing market, we're seeing cash purchases with a focus on absolute leverage levels, so people aren't pushing beyond 6 times leverage, EV to EBITDA 6 times leverage. And we're seeing the emergence of break fees, substantial break fees, as people try and grapple with the regulatory risk associated with closing certain deals. So we've seen the rise of the breakup fee.
And Charles, are there differences between how financial acquirers and strategic acquirers approach transportation deals?
Yes, I think you could break that down into two separate pieces. One is, where are they now in the cycle? And by and large, the sponsors, the private equity guys, they are sellers, and the strategics, the corporate buyers, are buying from them. The other way you can break it down is how they behave in M&A. And we see often strategics, corporate buyers being much more methodical, much more honest, much more straightforward, much more able to finance and much more able to use synergies as a sort of currency. Whereas the sponsors are perhaps a little bit more nimble and will play a cleverer game sometimes, particularly with the way in which they deal with purchase and sale agreements, so that at the end they leave themselves in a position where they've left other people out, or they've put themselves ahead of other people.
And lastly, where are you seeing the most successful integration strategies, and what should buyers be mindful of in the diligence process?
Well, I have my own personal checklist on that front, and I'm happy to share with you a few thoughts on that. In my experience, you see a lot of forecasts being put out, and people buy into those forecasts. So really understanding who owns the forecasts is a critical part of M&A. We've also seen the emergence of trapped cash in certain situations. So really focusing on the presence of trapped cash and whether or not it really is trapped, and whatever discount needs to be applied to that, and indeed what happens to that trapped cash as part of the deal. A couple of other things. Peak working capital tends to trip people up, so not really having an understanding of these great fluctuations you can see in peak in working capital can affect the way in which buyers are able to crystallize synergies. And I think the other big issue is the systems integration. So we've seen a lot of companies underestimate the complexity around integrating systems, and a lot of the ability to deliver on their synergy promises are based on how well you manage that systems integration.
Charles Otton of UBS, thanks so much for joining.
Thank you, Mark.
And thanks for joining. To watch Merger Talk, visit thedeal.com.